That time of the week we talk politics and, of course, the economy. Zach Abraham, Chief Investment Officer, Board Capital. First, my buddy sent me something today. The cardboard index. They're making less cardboard, which means they're making less stuff to ship and/or things are coming in. And they said this is one of those weird indicators. And I thought, oh, I got to ask Zach this about slowing of the economy. We can go over the jobs and stuff, but the cardboard thing made me laugh.
Yeah, the cardboard indicator. That's interesting. You know what's funny? I've never actually heard that. I probably have heard of it. I mean, there's probably not an indicator that I haven't crossed over at some point. That's interesting though, because that's not a bad way to look at things, especially today in the online marketplace, right? Um, I'm not going to assume that everybody else is like me, but I will tell you in my family, there is a direct correlation between the amount of cardboard that we produce and the amount of things that my wife has purchased from Amazon, right? So it's actually a chore. It's become a chore at my home, which is really funny because that chore didn't exist when I was a kid, but my boys have to go out and bust up the cardboard once a week. So that's really it. I'm actually going to have my analyst look into this, Chad. So here's the deal. Again, you have to be very careful when you say this because you and I both know economies move like EKGs,
Yep.
right? You step back and you see a trend, but in the meantime, it's this, right? What I will say right now is every sign we are seeing points to stagflation, which is the worst thing. Um, I will also say that it's not pointing to it as in like this is here right now. There's 90-mile-an-hour winds outside right now. Bar the doors. It's right off the coast. Not saying that, um, but when I see inflation threatening to push above 3, and then I see jobless claims numbers like I saw today, those two things do not occur together very often. And as a matter of fact, I don't, this is not gospel, but I would bet you that this is the most stagflationary signs we've seen in a compressed period of time, probably since the 70s. I'd have to go back and comp that, but this is very rare what you're seeing, right? What you typically see is almost lockstep. They might be moving. Typically, inflation and economic growth are tied at the hip, right? They're going in the same direction. Um, and when I say economic growth, I mean real economic growth, and I think it's important that we think about that. And in that way, I think employment numbers are more important than ever. Why do I say that? Because when you're in an environment where government's 130% debt to GDP and running 7% deficits, I think traditional GDP metrics mean less, right? Because the government is becoming a bigger percentage of the overall economy. Therefore, I actually think that you need to sit and look at job numbers and probably play them a little bit more credence. So i- i- it just looks stagflationary. Nothing looks horrible on the data side of it. Prices continue to push higher. The stock market continues to really ignore a lot of things. That being said, we're having a phenomenal year. Uh, and those things make a lot of sense, not just because they're working, but because we're there at valuations that are very attractive. Just like I've been saying all year long. There's a lot of great stuff out there. Gold miners, you know how I feel about them, right? Everybody kind of poo-pooed that and told me, oh, gold miners are bad businesses. Year to date, GDX, the gold mining index, is up 100%.
That's
So,
that's great. I mean, that's a win
so
right there. I mean, that is.
it's a
Talk
big win.
Chief Investment Officer, Board Capital. Uh, I don't think people realize like the whole stagflation thing. They're like, why is stagflation worse than like a recession? Because man, I tell you what, stagflation is running uphill in quicksand. You would
Mm.
rather fall the way down the hill in a regular hill than try to get up a small hill in quicksand.
Yeah, so stag I think there's two different ways to look at this. The reason stagflation is not a good thing is that let's just apply it to our own lives. None of us like it when the cost of a McDonald's value meal goes up. Okay? But if let's say the cost of a value meal goes up 4% in a year where you get a 20% raise, That's not, you're probably not going to be crying about the 4% increase on the Why? Well, because yeah, there's only a 16% delta between the two, but the 20% raise applies to $100,000 a year or $80,000 a year, not 399, right?
Yeah.
So you gain a lot there. Okay, now flip it around. Let's say your wages are going up 2% and cost of living's going up 10. That's stagflation, right? Usually when we see prices going up, i.e. the 70s, and this is one of the biggest things that's missed with the 70s. Were there policy problems? Yes. Was there bad policy by administrations, especially late in the 70s? Yes. Were there bad policies early in the 70s? Yes. Did we spend too much on Vietnam? Yes. All of these things contributed to inflation. But the real driver of inflation was the largest history in the history of our country coming into what we call family formation age, right? We had a deer going through a python, right? And when that deer got to the age of 25, i.e., started to get married, bought a house, have kids, all of a sudden you've got this economy that's prepared for 3 to 4% population growth, and all of a sudden now it's sitting around staring at 6.5, 7, right? So meaning it's going to take a while for the underlying parts of that economy to catch up to the demand. When you are sitting there looking at a stagflationary environment, costs are going up, but it's not being driven by growth, right? So wages aren't going up, productivity isn't going up. And so that's the worst of both worlds, right? In a true inflationary environment, I can go out and get a new job fairly easily and get paid more. In a stagflationary environment, I can't. And in a stagflationary environment, I may lose my job. So that is the worst of both worlds. But here's what, now I'm not saying we're here. Here to me is the scariest aspect and the most pernicious part of stagflation. Typically, stagflation is caused by currency degradation or a breakdown in an economy or a government, right? Because one way to get stagflation is to have a contracting government or a contracting economy in real terms, meaning adjusted for inflation, and a falling currency valuation, right? So one of my fears, the reason I think that we're seeing stagflationary signs is that we have reached the end of the runway or we're very close to it as far as using monetary policy, i.e., quantitative easing, artificially low interest rates as a driver. Because if you try to push on that now in a stagflationary environment, you will most likely immediately, you may get positive response on the growth side, but typically whatever feedback you get on the inflationary side more than cancels it out. So it's not useful, right? That's my fear that we have been hitting this antibiotic, we have been hitting this painkiller for so long that if the real infection starts, that antibiotic isn't going to work. That painkiller isn't going to work.
No, I mean, and as you said that, I'm sitting here thinking to myself, if you're the Fed and Trump really wants you, first of all, who knows what's going to happen with the tariffs, right? And that could just be a nightmare if they rule against him and coming up in November and they got to pay all that money back. Boy, that'd be sideways. But then you're looking, and if we're in that stagflation area, we're getting close to that. Like you said, dropping a rate we could see, it could do far more damage and not get the result they want, and maybe even set it back.
And you know what? Quite honestly, I really firmly believe you're there. I don't believe that monetary policy is the answer. I don't think the issue is that rates are too high right now, and an economy growing at 3% would suggest that I'm correct. Now, the tough part about that growth rate is you've got to and here's the thing I hate about modern media, Chad. You don't hear nuanced discussions like
No.
this, right? It's either tariffs are going to save the world or Trump is trying to destroy the United States and somebody should try to take him out, right? Like that. Those are the two takes you're going to hear. The world is so much more nuanced than that, obviously. Um, there are so many cross pressures, but where I truly think that you're at is that if you are looking to get this economy going forward, the monetary policy button, in my opinion, has exhausted itself. I think Trump needs to earnestly be pursuing the ripping down and restructuring of regulation. I think that we need to come up with some sort of new deal, and not in the way that it sounds like, but some sort of new deal to deal with a combination in a ripping down of regulations that are driving housing prices higher. I think we need to come up for some programs with kids that have good grades and figure out ways to simultaneously roll some student loans into potential home finance without letting them completely off the hook, right? Figuring out ways that we can, because the other thing that we've got to say is, and you're watching it right now, you're watching a surge in socialistic tendencies from younger kids. Why? It's understandable why. The Federal Reserve has been at the cost of every other generation. And I am not, guys, I know the people listening to your show do not fit this category. I know my clients don't fit this category. And every time I bring this up, I end up ticking a couple of them off. So let me put that caveat out there. But if you just sit back and look what has happened, right? We all know what is known and what is undebatable is that 70% of financial assets are owned by baby boomers, right? Okay. If we add up total home equity in the country, it's probably north of 70% owned by baby boomers. Okay. When we look at monetary policy over the last 25 years, what has monetary policy been aimed at almost exclusively? At the elevation of asset prices, right? So really what we've done is we have racked up the credit card and put it on the tab of millennials and Gen Zers, right? For the benefit of baby boomers. That's what we've done, right? We have targeted asset prices. So when these people are sitting there, and I understand the kids' frustration, but when they're sitting there saying we need socialism or socialistic practices to answer this, I would tell them corporate socialism is what got us in this mess in the first place. Okay. What you need to do is you need to rip down regulation, guys. If you'll just listen to me, right? I'm not driving a political ideology. What I'm telling you is where there is more red tape and more government bureaucracy, there is more cost, right? We've got to start dealing with things other than using monetary policy, because I believe we've painted ourselves into a circle and it is not going to be the driver. And the tough part about that is the reason monetary policy has been in the driver's seat is because Congress can't do anything.
No, and they never do. I'm talking to Zack Abraham, Chief Investment Officer, Board Capital. Tell everybody how to reach you and what you got coming up.
Yeah, we've got our free webinar coming up, I believe.
October 2nd.
God, you're good, man. This is why they pay you the big bucks, brother. October 2nd. And just going over who we are, what we do. It's designed to be a 45-minute free presentation that when you get done, you won't understand everything about us, but you'll certainly understand what actually being active managers mean. It means you'll absolutely understand what makes a difference. We'll explain how our main fund can be up 26, 27% in a year when the market's only up 11. Most people are like, well, wait a second, you can't be up more than the market. Yes, you can. And we'll show you how we've been down less than the market in down years. But anyway, it's basically like a free Zoom greet and meet, and you'll understand how our company works, how our fee structure works, who we are, how we do what we do, and with no obligation. If you do not want us to call you and fill out that thing, we're not going to bug you. Okay, we're not going to email you. So just a kind of a greet and meet, a way for you to get to know us and what we do. So you can do that at bulwarkcapitalmanagement.com, knowyourriskpodcast.com. We do our daily podcast, 30-minute summary of everything that's gone on politically and financially, and not hard to find. Bulwark Capital and Know Your Risk Podcast.
Right on, brother. Good talking to you. We'll do it again next week.
All right, man. Thanks for having me. Fun as always.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. Investments involve risk and are not guaranteed. Past performance doesn't guarantee future results. Trek 24308.